Hi, welcome you all in this private equity session. We're going to discuss about different structures of private equity fund. So if you look at the private equity business structure, private equity needs different structures to save taxes. So fund managers, basically with the help of legal advisors, they're registered different entities across jurisdictions or tax neutral jurisdictions to save taxes. From that context, we'll discuss quickly about different structures like limited partnership structures or alternative investments, master feeder, SPVs, and how structures looks like in the system. We'll discuss that. So the first structure is limited liability partnership structure. The limited partnership is the most common P fund structure offering tax transparency, limited liability for investors, and operational flexibility for fund managers. The Basically, GP manages the fund while LP provides capital and receive return to them. How structure looks like? Look at this. The general partner, which control and manage the funds. GP and LP come together. They establish the limited partnership. Partnership would be registered, maybe in US, UK, depends. And the investors would be like pension funds, family offices, insurance companies, sovereign funds. All right. So they all come together. Basically, GP and LP come together and they invest money in a portfolio companies. Portfolio companies, it could be startups or private limited companies. Right. So this is how your GP and LP structure looks like. GP means general partners, LP means limited partners. So basically, general partners manage the funds and even contribute capital also. So limited partners contribute capital and support fund, general partners to take management related decisions and manage investments accordingly. All right. So if I talk about, let's say, real examples, KKR North America Fund 13. The main fund, which is registered in Delaware, which is in US, and KKR's GP Associates, which is registered in North America by the name of 13 LP, and total size of the fund which they have 19 billions. GP committed 380 millions, right? And management fee again, which is 2% during investment period, and carried interest 20 and above 8 hurdle. So this is how they have set up the funds basically, right? And who are the investors? Scalpers, teacher, retirement system of Texas. They are the big investors for KKR. Then another, again, if I talk about the another example, real example, Apollo Global Management Fund 9, again registered in Delaware. The GP, they have their Apollo Management 9 limited partnership. They have a $25 billion investments under management, and their main focus is on large buyouts, North America and Europe. They have a total 10 plus years of experience. Sorry, means the fund life cycle is for 10 years, and if required, they can even extend it. All right. So now if I talk about advantage of this GPLP, advantage is like tax transparency, which is a pass-through taxation. It means they can pass taxes on limited partners and general partners. So partnership don't need to pay any taxes at a partnership level. Then limited liability, of course, though both the partners, they have a limited liability, operational flexibility for GP, well-established legal framework, and familiar to institutional investors and clear governance structures. If I talk about consideration, UBTI issues for a tax exempt investors, UBTI it means unrelated business taxable income. US tax filing requirements for a foreign LPs, which is required limited accredited investors, complex for cross border investments, GP, unlimited liability, state law, and variations. This is how GP has some considerations. Now, the next one is if I talk about, let's say, master feeder. Master feeder structure allows funds to accommodate both US taxable and tax exempt investors as well as non-US investors through separate feeder funds that invest into single master fund, and this creates operational efficiency while addressing diverse tax and regulatory needs. If I talk about master and feeder, look at the cash flow or capital flow. Master entity, it could be registered in Cayman or in a tax haven jurisdictions where, if they, let's say, even entity generates income, that income would be like tax exempted, right? And that master entity can have feeders may be in US, feeders may be in Cayman. For non-US investors, we'll call it as an offshore feeder. And for, let's say if the same master has a feeder in US, which is for a US investors, that would be US feeder fund. All right. So the US tax exempted or taxable investors or pension funds, they'll invest funds through US feeder, and the offshore funds where European pension or sovereign funds, they'll invest through offshore feeder funds. And here the fund master fund manager basically will take the decisions and deploy funds in portfolio companies. Portfolio companies, it means the investing companies basically, right? So if we talk about this key part, two feeder funds pool capital into single master fund, enabling unified investment strategy while accommodating different types of investor. If we talk about real examples, Blackstone Capital 7, BCP 7 master fund registered in Cayman, and US, they have a US feeder and even in offshore feeder. Total fund size with a $26 billion. This data again pulled as per 2016. US allocation 60% through US feeder and 40% to the offshore allocation. Another one is the Cali Partners 7. So CP, again 7 master fund LP, which they have registered in Cayman, and Khalil Partners again 7, their feeder registered in Delaware, offshore feeder CP registered offshore, a offshore fund registered in Cayman. Fund size 18 billion, single investment commitment they have offered to the investors, and with the unified portfolio management. Now, if we talk about the advantage of master and feeder, which accommodates diverse investors like onshore, offshore. If we have investors from on-site, off-site, you can accommodate in one fund through master and feeder. Again, this structure is like tax efficient structure. It's good for a single investment strategy, operational, economies of a scale, regulatory flexibility, and enhanced fundraising capacity. These are the benefits. If we talk about consideration, it is a complex structure, and the documentation would be little complex. Higher setup cost or ongoing cost, which is needed, multiple regulatory jurisdictions, transfer pricing, consideration also which is needed, potential conflicts between feeders, and complex reporting requirement. Then blocker corporations. Blocker corporations are C corporation that's it between P funds and certain investments to block undesirable tax consequences for a tax exempt or foreign investors, and they are particularly useful for investments that generate unrelated business taxable income or require US tax filing. See, basically blocker is a separate corporation and automate your tax filings. Look at this, the blocker entity will set up in between like feeders and masters. This is a blocker corporation registered in Delaware, because master fund registered in Cayman, and US feeder fund registered in Delaware, right? So basically, and even they have this particular structure has offshore fund registered in Cayman, so need non-US tax filing to calculate taxes and process it automatically. So here they have inserted blocker corporation. All right. So again, this is again structure. I don't want to go through each line, but advantage, if you ask me about the blocker corporations, Blockers eliminate UBTI for a tax-exempt LPs, protect foreign LPs from US tax, and simplifies limited partners tax compliance, enable broader investor participation, provide regulatory flexibility, isolate tax risk. Key considerations would be corporate level taxation, uh, then potential double taxation and additional complexity and cost, ongoing compliance requirement, limited loss pass through, reduced tax efficiency for some LPs. Another structure is SPV, means private equity funds can establish more and more SPVs to acquire assets. This is again one of the famous structure that you would see in a private equity funds. Special purpose vehicles are entitled special purpose vehicles are entities created for a single investments or a specific deals. They provide risk isolation, cleaner exit structure, and regulatory compliance while allowing for deal specific term and co-investment opportunities. Basically, look at the structure. Main fund can create a multiple entities across jurisdictions. Maybe one SPV in Cayman, another in Delaware, then third one in Luxembourg. And then under each SPV, fund can hold investments. Let's say SPV1 invested in target A company, tech startup, B in healthcare, C in manufacturing. An investor base should be depends on that jurisdiction. In Cayman, the Cayman-based investors will invest. In Delaware, the Delaware-based investors will invest, and in European, the European-based investors will invest. See, this is a something good structure for a risk isolation. So each deal ring of funds from main fund, co-investment access, additional capital from strategic partners, regulatory compliance, jurisdiction specific requirements can be met, and clean exit, independence till timing. If let's say if you have a losses in a one SPV that cannot affect on main fund. So again, it's an efficient structure to manage investments. If we talk about advantage, see, even if you talk about real example, Vista Equity Partners and Apollo Partners, they have a SPV structures, okay? If you talk about advantages, risk isolation from main fund, deal specific terms and governance, co-investors participation, then opportunities, independent exit timing, regulatory compliance, flexibility, clean transaction structures, reduce fund concentrations. And if we talk about concentrations, additional setup and ongoing cost, complex documentation requirements, separate entity management, potential conflicts between investors, limited diversification benefits, regulatory compliance burden, and exit coordination challenges. This was all about SPVs. And then if we talk about, let's say, alternative investment vehicles, parallel structure for specialized investors. Alternative investment vehicles are parallel funds created when certain investors cannot participate in the main fund due to regulatory, tax, or investment restrictions. AIVs follows the same investment strategy but accommodate investors uh, in a different way. Let's say here we have a main fund which is registered in Delaware and another AIV, means similar fund registered in Cayman. Cayman fund will take care of European investors and the Delaware will take care of US investors. The strategy would be parallel investment strategy, same deal, same terms, same timing, same investment in same assets. Look at the investments: US investment technology company, European investment manufacturing company, ASEAN investment in healthcare, and other Indian and China deals. So this is how parallel structure. Parallel, it means similar set of entity we need to establish for a bigger investments. If we talk about advantage, accommodate restricted investors or big investors, same investment strategy and terms, regulatory compliance, flexibility, broader fundraising capacity, maintains investors' relationship, and pro rata participation in deals. Key considerations should be additional fund structure complexity, higher setup and operational cost, multiple regulatory jurisdictions, coordination between parallel funds, potential conflicts of interest, and complex reporting requirement. So there are the, basically guys, fund structures where every fund manager and his or her legal team, they take care of it establishment of fund structures or entities across different jurisdictions. If you want to, let's say, understand the structures for your own funds or business, you can reach out to us. Or if you're looking for a job and if you want to understand the accounting of each structures or reporting for that matter, you can reach out to us. My team will take care of it. Or if you want to, let's say, learn a fund, private equity fund in details and want to understand the key terms of a private equity, then still you can reach out to us. We'll help you to upskill on private equity part because private equity is one of the highly growing market at the moment. All right. So if you like this, please do comment, subscribe, and share with your friends or people who want to, learn this private equity products. So we'll see you in next episode. Thank you. Thank you very much. We'll connect. All right.